Hello, and welcome to the Quarterly Investment Review. We're going to be looking at some facts and figures, plus interpreting that information through the lens of evidence and what is known about investing, and finally to understand the importance of being patient and taking a long-term perspective. Well, let's start off with the stock market returns from last year. Canada finished strongly with last quarter of last year returns up over 5%. However, during the year, the returns were negative 5.8%. The US market had a similar kind of trajectory. It finished very strongly. But at the end of the year, it was down 18.1%. That's a huge decline for the market. It hasn't been that bad since the financial meltdown of the 2008. And then the global markets also had a good finish to the year, up over 15%. But at the end of the 12-month period, they were down 9.3%. This information comes from the S&P TSX, the S&P 500, and the MSCI index for developed countries, excluding Canada and the United States. So, what can we learn from this information? Should we see that Canada was the best performing stock market, actually by far? Should we shift more of our portfolio into the Canadian market? Well, let's take a long-term perspective on that one. I've been looking at Canadian returns versus other country returns now for several decades. And what usually you see is the Canadian returns are lower than elsewhere in the world. So a broadly diversified international portfolio has significantly outperformed the Canadian returns. Plus, it's had lower volatility, less ups and downs. So for two reasons, you want to have a very strong, diversified portfolio. How about nerves? What we do know is that when individuals, people, investors, get nervous, they tend to be more reactive. And the volatility in those types of markets, both up volatility and the down volatility, tend to be more severe. Well, last year we had COVID to deal with. We had rising inflation. Central banks, including our own, were increasing interest rates significantly to try to control inflation. That was very hard on households, very hard on business. And also, Russia invaded Ukraine. And that, I think, put our supply chain, normal distribution channels for energy, for example, in disarray. And I think that's what happened in Canada. I think Canada prospered from the war on the energy side. If we look at bonds are supposed to be the ballast of your portfolio. They're not supposed to go down. And if they do go down, they're not supposed to go down very much. Well, according to Bloomberg figures, Canadian bonds and also global bonds, they declined 11% last year. That is a huge amount. Again, bonds are supposed to be your ballast. That's not supposed to happen, and it doesn't happen very often. Should we abandon stocks? We've seen a lot of volatility. Well, I'm not sure that's a good idea. And the reason being is if you look at stock performance as measured by the S&P 500, measuring 500 of the largest companies publicly traded in the United States, since 1926, over the last basically 100 years, for every 1 year of decline you have 3 years of appreciating. Now, that doesn't always happen consistently, but basically, a quarter of the time you lose money in the stock market, 75% of the time you make money. So that's why having stocks as part of your portfolio makes sense over time. Let's talk about value investing. Now, what do I mean by value? Well, there are two types of stocks, value and growth. And for equal companies with equal book values, you'd think equal net worth, the value stocks trade at a discount and the growth trade at a premium. And if you look at history, and there's been a ton of research on this, if you look at history, value companies have done better over time. Now, the most significant research in this regard was the three-factor model published in 1992 by Professor Fama and Professor French. And that is one of the most highly cited bits of academic research in all of modern finance. So values do perform better, but like the markets, they don't always. There have been several of the last years where it hasn't performed. However, recently, the last couple of years, it's performed extremely well. Another example how you want to be patient. Your long-term financial success built on a financial plan requires you to have a certain amount of return over time. The best way to take that long-term approach to financial planning is have a long-term approach to your investing. That's what we recommend. Well, we hope you've enjoyed this quarterly update, and we wish you all the very best for the year to come.